As we pointed earlier, the Brent is also gaining for the 5th straight week, and it is set to post their biggest monthly gains in over a year. Now, what is aiding the rally and what impact does it have on the OMCs? Somit is here joining us with some more details. Somit?
Well, if you see, Brent Crude is trading around the $85 per barrel mark. Now, this is the fifth for the last 5 consecutive weeks. Brent has been continuously gaining, and for the month of July, if you see, the gains so far has been close to 13.5%, which is the highest monthly gains that Brent has seen since Jan 2022. And from the recent low of around $72 per barrel, the prices are up nearly 18%. Now, what are the reasons behind this rally? Firstly, is the tightening supply globally, rising US gasoline demand, the Chinese stimulus measures, and given the fact that the market is also considering that central banks globally are at their last leg of a rate hike. Now, whom does it impact the most in India? Well, it will impact negatively the oil marketing companies. Now, this because of this rising crude prices, the marketing margins that oil marketing companies earn on selling every liter of petrol and diesel, that has come down drastically. Now, at the start of June, where crude prices were around $72 per barrel on petrol, the gross marketing margin earned by oil marketing companies stood at close to 13.7 rupees per litre, which has now come down to 5.6 rupees per litre. And on diesel, they were earning a positive margin of around 9.1 rupees per litre. However, the margin has now turned negative, and in fact, on selling every litre of diesel, the oil marketing companies are losing money, and that is to the tune of around 2 rupees per litre. Other than that, the oil explorers like ONGC, Oil India, Vedanta and HSC, for them largely the rising crude prices should be positive, but given the fact that the government has been changing the windfall taxes, there might be an increase in the windfall taxes, and largely the impact on these companies is expected to be neutral. However, on the negative side, then there are paint companies, aviation companies, tire companies. For these three sectors, nearly 40% of the total RM cost is either crude or crude derivative prices related. For lubricant manufacturers, nearly 50% of that total RM cost is crude related. For cement companies, it's nearly 40 to 50% of the total RM cost. And there are a host of specialty chemical companies where the raw material prices are linked with crude prices, and a rise in crude prices would also lead to a rise in their raw material cost, and hence could impact negatively to them as well.
Amit, thanks for all those details.